Today, July 20th, market downside accelerated as quantitative CTA models breached critical sell trigger levels. Model estimates from institutional trading desks indicate that momentum algorithms hit automated sell thresholds on both the Nasdaq 100 and the S&P 500, sparking a systematic deleveraging phase across global equities.
This mechanical unwind is being amplified by cross-market retail margin call liquidations in overseas hubs like South Korea. Because trend-following CTA funds execute trades algorithmically rather than company fundamentals, their selling remains automated regardless of earnings beats or economic headlines. The selling pressure is most visible in the semiconductor sector, which has now officially fallen more than 20% from its late June highs into technical bear market territory. Investors are increasingly selling the news on solid earnings reports, signaling that market expectations had risen too high for current revenue conversion speeds. At the same time, scrutiny around AI infrastructure spending is intensifying. As low-cost Chinese inference models enter the market, hyperscalers face growing questions about the return on their capital expenditure plans, just as big tech earnings season gets underway this week, with Alphabet and Tesla reporting on Wednesday. Adding to individual stock headwinds, SpaceX is facing supply pressure following its recent Nasdaq 100 inclusion. Market data highlights upcoming lockup expiries in August and September, releasing additional share supply into the market after the initial passive indexing front-running phase has passed. Looking beneath headline index performance, internal market divergence remains stark. Over 177 stocks, representing more than one-third of the S&P 500, remain in negative territory for the year, demonstrating how top-heavy mega-cap gains have masked deep drawdowns across broader market sectors. This broad pullback in software has created notable valuation gaps in established SaaS leaders. Names like Intuit and Adobe are currently trading at significant discounts to their historic free cash flow multiples, presenting potential value opportunities for long-term investors as the market penalizes non-AI tech names indiscriminately. Yield-seeking investors are also witnessing extreme valuation splits between legacy tech and traditional dividend payers. While legacy tech names like Intel face deep free cash flow deficits amid heavy foundry investments, traditional media players like Comcast are trading at historic dividend yield highs near 5.5%, with low payout ratios. From a macro perspective, U.S. equities now represent a historic 64% of global equity benchmark indexes. This high concentration drives massive, inelastic passive fund flows into U.S. markets, regardless of underlying valuations, leaving index positioning particularly sensitive to sudden sentiment reversals. This week marks a crucial test for market sentiment as Q2 earnings season accelerates. Alphabet's Tuesday report will serve as a primary indicator for hyperscaler AI capital spending, while Tesla's Wednesday release will test auto gross margin floors and energy storage growth assumptions. Beyond direct silicon manufacturers, non-obvious industrial beneficiaries of AI buildouts continue to show strong operational trends. Comfort Systems USA has delivered over 2,000% gains over 5 years, as specialized HVAC thermal cooling for data centers has expanded to account for nearly half of its record backlog. As systematic deleveraging unfolds, institutional capital is rotating away from crowded momentum trades into defensive value and high-yield sectors. This shift underscores a broader market transition from rewarding unconstrained growth promises towards prioritizing immediate cash flow generation and margin safety. To navigate the week ahead, traders should monitor key CTA re-entry levels on the S&P 500 and Nasdaq 100, alongside semiconductor index consolidation zones and Wednesday's big tech earnings releases. Keeping risk management tight during quantitative unwinds remains essential as market breadth realigns.